Well, the future of Qantas is firmly up in the air tonight after it revealed its full-year profit could plummet by up to 90%. The airline has blamed its newly separated international division, where it says losses will more than double this year. Investors reacted savagely, sending Qantas shares plummeting to a record low. Andrew Robertson reports.
The strength of the share market reaction shows just how blindsided the investing community had been.
A 90% profit downgrade is probably the largest of a major stock since I've been in the industry.
Just 2 weeks ago, Qantas announced it was splitting its operations into separate international and domestic airlines, raising hopes of better times ahead. Not this year, though. The airline says pre-tax profit will now be $50 to $100 million, down from $500 million last year. It says Jetstar and Qantas Domestic will lift their earnings to more than $600 million, but the losses at Qantas International will more than double to over $450 million.
That's primarily due to two forces. The first is the price of jet fuel, which has grown by about $20 over this financial year compared to the last financial year. It's also attributable to the weakness in the economies to which the Qantas Group's most exposed.
The post-profit warning nosedive took Qantas shares to a record low of $1.16, less than a fifth of their value 5 years ago. In 2008, a private equity-backed consortium was willing to pay $5.60 a share for Qantas. Private equity is again believed to be circling.
They were probably looking at it a month ago, so I suspect that it's reasonable to conclude that they'd be looking at it more closely now that it's 20 cents cheaper.
For Qantas boss Alan Joyce, the profit downgrade is another setback for a company that consumes billions of dollars in capital every year and, with its dividends suspended, gives nothing back to shareholders.
He's doing a darn good job and management are working really hard, but it's like beating a dead horse. It's a really tough business.
When Australians check in to fly domestically, more than 60% of them choose Qantas. The problem for the national carrier, though, is when it comes to international travel, that number drops to just 20%. Or to put that another way, when Australians travel overseas, 4 out of 5 choose airlines other than Qantas.
They're competing against airlines in the international sphere that don't have to make a profit. Etihad, Singapore Airlines, they don't have the same profit requirement that Qantas does, therefore they can afford to do uneconomic things.
Like offer much lower ticket prices, but despite that challenge, Qantas remains confident it can have its international division back in the black in 2014.
It's unlikely but possible, but they've got a welter of all sorts of different issues they've got to cope with. Rising fuel prices, instability in countries, in destination countries that they're flying to, geopolitical risk, and looking at a recession in some of their big markets like Europe.
And just to add to Qantas's worries, Etihad has lifted its stake in Virgin, a sign of confidence that Qantas's arch rival on the domestic front is set to get stronger. Andrew Robertson, Lateline.